Welcome back to First Trades right here on ET Now, and we have Devina Mehra, founder and CMD of First Global on the show right now. Hi Devina, morning and great to be speaking with you, and it's indeed an interesting time to have you on the show because of late the Indian markets are not performing that well, but globally there's a lot that's been happening with respect to tariff, as well as the rate cut announcement is also expected in the times ahead. So Devina, let's start with the global setup right now, because you have always advocated that one should not concentrate your portfolio in one geography. With respect to the tariff announcement and what the global sentiment is like, help us understand, where do you believe the outperformance can be through, and which markets are looking good to you right now?
Hi. So as I always also say that not only should you be global, but global doesn't mean only the US. So you need to be diversified across countries, because no theme lasts forever in markets, whether it is countries, whether it's asset classes, or within a country industry. So that keeps changing. Of course, we will be doing our rebalance globally. We haven't done that yet for the quarter. Where we are positioned currently, we are somewhat underweight the US. So since January, we have been underweight US. We have been overweight Europe. China, we had been overweight even earlier. And India, we have been slightly overweight. So broadly, that's been the global thing. And of course, there are individual countries that look good and all that. But as a broad thing, Europe has been outperforming the US, so that's been one big trend. And maybe China, after years and years of being in the doldrums, because must have mentioned that statistic sometime or the other, that the Chinese market made its previous high in 2007, and the GDP went up 6 times, and that high was not taken out. So that was also a setup. Tariffs, of course, there's been some agreements that they have come to, and also, like, for example, all this thing of Japan investing X amount into the US. Ultimately, Japan will say this is all individual company decision. So I think you're just kicking the can down the road on that. And but ultimately, the markets have decided it is business as usual.
Right, Devina, hi morning. This is Nehi also joining in. Surprised to hear that you're underweight US right now, given the kind of upswing that we've seen as we get more and more clarity on the tariff front. But Devina, if you're underweight US right now, where globally are you placing your overweights at the moment?
That I mentioned, that we have been, since January, we've been underweight US and overweight Europe. China, we had been overweight from last year itself. India, we are slightly overweight. So, and Europe has outperformed the US quite considerably this year.
Okay, Devina, point taken. When you say overweight on India, I want to understand what's looking good, because traditionally at a time like this, when there's so much uncertainty, we're always advised to take a look at blue chips with the whole get and forget mentality. But right now, in terms of earnings, even the blue chips aren't delivering. Where would be a safe space in the Indian market right now?
So when I said we're only slightly overweight India in our global portfolios, not by a massive amount, but I was smiling at the buy and forget, because in the markets there is no such thing as buy and forget, because the definition of a blue chip changes all the time. So you look at the history of both the Sensex and the Nifty, and you look at which companies were there at one point and where they are today. I mentioned this if you look at the original Sensex list, you had all the Thapar Group and the Scindia Group and the Mafatlals and Hindustan Motors, which used to make Ambassador cars, or Premier Automobiles, which used to make those old Fiat cars. So all those companies have gone way into history, India's steamships and all that. And those were all blue chips. They were all companies with decades of history when the Sensex came into being. The only company with a relatively short history at that point was Indian Hotels. All other companies had really long histories and were the blue chips. Often when I talk to people also about their grandparents' portfolio, and you'll find that this stuff with all those old groups that I mentioned, JK, Thapar, Modi, Scindia, Mafatlal, which have all kind of passed into history. So the definition of blue chip keeps changing, which if you look at Nifty also, how all the stocks that were in Nifty at one point, or even in the general composition. At one point, there were no banks in these major indices. Now, banks and financials are the biggest weight. At one point, towards the end of the 90s, all you talked about was PSUs. There were so many PSUs in these indexes: MTNL, BSNL, BHEL, ONGC, Indian Oil, HPCL, BPCL. I could go on, and then there came a phase when you forgot that you can even invest in PSUs, that they are listed companies. So all these are phases in the market. There is no such thing as buy and forget particular stocks and just wait for 20 years and you will be rich. The data doesn't show that. Data only shows that the ones you pick are the survivors or the successes. So you forget about all the things which fell off the radar, even in particular industries. HDFC Bank and Kotak Mahindra gave you the compounding, but there were so many others who got license around the same time. Times Bank, Global Trust, Centurion Bank, and so many PSU banks. Yes Bank went through such a big problem. So we only think of that, if I had bought this here, it would have compounded to X, but you wouldn't have bought just that one stock. And I actually looked at somebody's mother's portfolio from the early 2000s that she hadn't looked at for 20 plus years. And there you had all the DSQ software and Penta Media and EPC Micron. And so that is another thing altogether. So, in any phase, the stocks that go up in the next bull run, they are not the same stocks that go up.
Right. Point taken, Devina. And I hear you and completely second the thought. Hi, Mansi, this side. And yes, while we see the next big headline at present, at least for this week, will be the tariff deadline, the 1st of August. But we have seen a lot of developments coming in over there. Of course, for India, the negotiations are still underway. But while you're talking and giving your views on the market, what's your view for the market participants? I mean, how should one mitigate the risk at present? We see a lot of global happenings, and at the same time the earnings trajectory, we are midway. We don't see any froth coming or any good signs coming, at least from the domestic earnings picture also. So how should the market participants behave at this point in time?
Yeah, so domestic earnings till now has been mixed, but I think the somewhat good news will come from the second quarter onwards in earnings, which was my stance even earlier, because see, there have been some good macro developments. One, of course, you know that the GDP came out ahead of estimates. But more than that, on the consumption side, one thing which will boost earnings is the lower inflation, especially in food and crude, and therefore the crude derivatives. So because India, relatively, the household budgets are very stretched. So if the dal and oil prices go up, you might stop buying soap or shampoo or something like that. So that's that was the overhang for the last, I would say, almost 2 years. And I even saw some statistics that even the household, the food thali kind of has not. It's not just that the inflation has come down; the prices have come down, which of course is on the other side. You can say that for the agriculture segment, that means that realizations have come down. But for the urban consumer or the non-farmer consumer, let us say, there's actually more room in the household budget, which should boost consumption. And when I mentioned crude, of course, all the downstream products of crude are inputs for many industries. So I would think that over time, you will also see some positive moves on the margin front. So, I would think there will be some improvement on both the revenue growth and margins. And as far as the investors are concerned, I always say that good investing is boring. So, which is why people tell me that many times you repeat the same advice, because the advice doesn't change every 2 weeks. And which is that never be 100% invested in equity, but whatever is your equity allocation, most of the time it makes sense to be invested, because when people are asking these questions, that there's uncertainty and fear and all that, typically that's when you might get a very sharp up move in the market that you miss. So on the other hand, of course, there is I'm not saying the market cannot go down from here and there is no downside, but you always have to look at the risk reward that what is the potential downside versus the upside. And again, I'm repeating that if you miss out the 10 best days in 40 odd years, you give up 2/3 of your return. So most of the time you can't afford to sit out.
Absolutely, Devina. Hate to cut our conversation short due to paucity of time, but hope to chat with you lots more next time. Thanks so much for joining us.